Kia, ngā mihi nui kia koutou. E no raurangatira mā, nau mai, haere mai, whakatau mai, ki tēnei hui mariko. Ko barikotahu, ko te kaiarahi o te patea whaiwhakaro. Reira, tēnā koutou, tēnā tātou katoa. Tihei Māori ora. So, a very warm welcome to you all. I'm Barry Coates. I'm CEO, founder and CEO of the charity Mindful Money. We provide information to members of the public on investment, and we promote ethical and impact investing, which we're going to talk about today. So this is the 16th seminar of this series, not many to go, so make sure you have a look at the previous seminars, which are all on our website. Seminars are held on Wednesdays at 12:15, and the videos and also the podcasts are available on, not only from our website, but also on YouTube and other websites. Today, we're going back to the foundations of ethical investing and responding to the questions that people typically have about, what is in ethical investing. So we hope that all of you who are joining us today online can also add your questions. So you can see the question function at the bottom of your screen. One sort of caveat before we start, we're going to be talking about some specific funds during this seminar. The purpose of the seminar is about information for ethical investing. We are not offering financial advice for any individual or any recommendation for a specific fund. So with that caveat, I would now like to warmly introduce our guest today. Let me introduce Moana Nottage. Warm welcome to you, Moana.
Thanks, Barry. Really good to be here, and quite excited to answer any of the questions that the audience might have on sustainable and ethical investing.
Great, and I'm very excited to welcome Moana because we had a little bit of technical difficulty just before this seminar started. So hopefully all's well. So to introduce Moana, she's an ESG, which we will explain shortly, and Sustainability Analyst at Alphinity, which is a Sydney-based fund manager that manages both core equity funds and sustainable equity funds. And again, all these terms will be unpacked shortly. A large part of Moana's day-to-day work is analysing the sustainability case for companies, engaging with the companies and ensuring that they're managing their social and environmental footprint. So, Moana, do you want to just add a few words about yourself and Alphinity?
Yes. No, again, really good to be here, and I've been with the business for 3 years. I actually have a background in biology and science, and trying to meld the two kind of paradigms together. How does finance, how does environmental, how does social really try and drive sort of positive shareholder returns and the long-term value of a business? The work across the both domestic and global core equity funds help with sort of ESG integration, which we'll dive into a little bit later, as well as form the sort of sustainability assessments that our sustainable companies within our funds are into. So that's a great overview of myself.
Very cool, and I'm sure we'll hear some benefit of your experience during the seminar. I'm going to start off with the basics, and the basics are that we often get is what is KiwiSaver and how does it work? So, with apologies to all of those who know the answer to this very well, but we just kind of wanted to lay out the starting point. So, KiwiSaver is a retirement scheme. As a KiwiSaver holder, you're invited to contribute your own funds to supplement whatever you get from when you're 65 from a government superannuation scheme. So this is your fund. An attractive feature is that your employer will contribute at least 3% of your salary into your KiwiSaver. And every year, in addition to that, the government will add $1 for every $2 you put in, up to a limit of $521 a year. So in a way, for most people, that's a substantial kind of incentive to go into a KiwiSaver fund. So you get to choose your fund manager. And what they do is they put your money into a pool of investments, and they're invested in companies or in banks or in government bonds, loans. Uh, so that then provides the investment pool. You get a share of the pool depending on how much money you put in, and you get financial returns. Hopefully, in a good year, you get financial returns, and a bad year, and there are always one or two bad years, and amongst a lot more good years, you can have financial losses. Uh, so all of this sounds good, and you can generally get far better returns from this kind of investment than you ever would from putting your money into a bank or a term deposit, etc. And again, we'll come back to some of those issues. But there's a catch. You can't get your money out from a KiwiSaver fund until you're 65 years old, or until you buy your first house. However, if you do get into hardship, there is a way you can apply to get part of your savings out early. So that's the basics of KiwiSaver. And, once again, if you've got more questions about any of these things, please add them into the chat. We often also get the second question, which is, why do people invest in funds instead of individual companies? Moana, do you want to explain?
Yeah, I can kick off, and if you had anything to add, please do. So, one of the main benefits from sort of investing into a fund is diversification and balancing of risks, I would say. I mean, funds are managed by investment specialists that are deeply knowledgeable in the space, and you can also gain sort of investment exposure to different asset classes, different geographies. And these managers generally follow the macro environment and the stocks more closely, and you can leave their sleepless nights to maybe global managers overseas that operate in different time zones. And another point I think is to make, if you're investing your money through a trusted advisor or a fund that has values that align to your own, and through that sort of ethical investing lens, they have quite a large shareholder base and your shareholding base, and they have a really strong voice and connection to management, and they can access boards, access management on key sustainability issues. So that's one of the benefits of I think investing in a fund and having that big shareholder base versus sort of an individual investor on the street.
Yeah. In New Zealand, a lot of people invest in individual shares through websites like Sharesies and Hatch and others. Um, One of the reasons to invest in funds instead of just picking individual companies is, as Moana said, when you diversify, when you invest in a whole lot of different companies, then in a way you'd lower your overall risk. So you'd lower the risk that any particular company might go belly up and you might have losses. So if it's spread over lots of companies, then that lowers the chance of that happening to any any individual one, or it means it matters less to you when you've got a diversified portfolio of shares. The other thing is, again, to echo what you said, Moana, I guess an important one is that fund managers are generally very experienced, and it's their job. So they're good at keeping track of what's happening to these companies in a way that sometimes individuals can't do, because it takes a lot of research to keep on top of what's happening with particular companies, and when you should sell or when you should buy into companies. And generally the kind of professionalization of fund management means that they can do the research that individuals really can't. The downside is, of course, you pay fees for those fund managers. Let's move on to a question we get a lot. So, what does investing ethically mean, or ethical investing? And it's partly because people get confused by the terms. They hear about ethical investing or responsible investing or green investing or ESG or sustainable investment, etc. Moana, do you want to just give us a snapshot on what all these different terms mean. Are they really that different from each other?
Yes. I mean, at the moment, there isn't really a guidebook here, probably in Australia and New Zealand, as to what an ethical fund looks like or what a sustainable fund looks like. But in my mind, it sits on a bit of a spectrum. So on the left-hand side, you might have funds with no investment restrictions or kind of sustainable aspirations. So they just operate as a core manager. And then on the other side, you do have sort of impact funds that do have a specific environmental or social objective. And in the middle, you have all of the others, and platforms such as sort of Mindful Money, as well as Responsible Returns, that's run by the Responsible Investment Association between Australia and New Zealand, do provide that kind of filter to try and compare what one fund does compared to the other. But the two primary sort of approaches, I would say, that sit in the middle would be a negative screen approach or a positive screen approach. So most ethical funds or sustainable funds at the moment do have a negative screen and exclude sort of harmful industries or sin industries, such as sort of alcohol production, got gambling, fossil fuels, tobacco. And then the second bucket is a little bit more sophisticated, and I think it's the way that funds are moving. So it's that sort of positive sustainability thematic. So trying to structure green funds or climate funds that invest in companies that provide solutions to environmental problems. At Alphinity, we invest in companies that contribute to the United Nations Sustainable Development Goals, and we look at the positive and negative alignment of those sort of company products and services to those to arrive at a net score, and that sort of defines what sustainability means for us.
Yep.
And then sitting on that,
So you carry on.
No, I was just saying, sitting on that far right side, on the impact side, we're seeing kind of sustainability linked bonds in the debt market sometimes, and also specific sort of private equity funds, for example, that have an objective to deploy certain megawatt hours of renewable energy in a year or recycle a certain amount of waste that's collected. So that's how I think about it.
So we'll come back to each of those issues a bit, but we find that this diagram's kind of a pretty simple one that helps people understand the main kind of strategies to invest ethically. Over the left, in red, you've got the traditional funds, and generally those fund managers ignore the impact on society or the environment. And then what's happened over hundreds of years is that the people who have money, and it's particularly been religious organizations like the churches who wanted to avoid slavery, or investors who wanted to avoid investing in apartheid South Africa, or otherwise it was generally a kind of avoid harm box. And that's the first one, second one in orange. Avoid harm means you screen out the things that you don't want to invest in. Up the top has become more kind of popular recently, which is you exclude the worst companies, but then you engage with companies in order to improve their performance. And that's what kind of fund managers do when you pull the money into a fund manager. They then have the power to do that kind of engagement to influence the companies. And then you get further down, you get better standards where you invest deliberately in better companies with those higher standards. And finally, as Moana said, you got on the right-hand side something called impact investing, or sometimes called positive impact investing. And this is where you invest to deliberately create a positive impact. So typically that's a benefit to the environment, or to social conditions, or to climate change. And the thing is, it still makes a financial return, often a very good financial return. So it's not philanthropy, it's not charity, it's not a donation. It's actually a style of investing. And we'll come back with various examples of what that impact investing looks like. So that's just an orientation for our discussion, and then kind of what we're going to talk about in each of these categories. I would say when people talk about ethical or responsible or green or ESG or sustainable investment, typically they're talking about similar things. there generally are some nuances to those words, but actually, in terms of common usage, for most people, they hear the words, and generally the most common usage is around ethical investment or positive impact investment or impact investment. So the next question that we get is kind of, so is is this kind of popular with the company, with the country, and do other people do it? So I'm just going to talk a little bit about the surveys that we do. So Mindful Money does surveys together with the Responsible Investment Association of Australasia, and it kind of measures people investing ethically. And what we find is that most people uh, not only want to invest ethically, about three quarters of New Zealanders, but they also want to know what companies they're invested in. And they say they will not invest in those funds if they find out that the companies are inconsistent with their values. So the kind of issues they want to avoid, and there's a really high percentage, people want to avoid companies that violate human rights, or companies that use practices that are cruel to animals, or those that cause environmental damage, weapons producers, fossil fuel producers, etc., and producers of tobacco and gambling, etc. So there's a list of those kind of issues. And what we have is we've added up kind of, so given these preferences, how much is actually invested in KiwiSaver in exactly those things? And the answers may surprise members of the public, because out of KiwiSaver funds, which in total is about 90 billion of funds in all, so of that, there's about 2.8 billion invested in fossil fuel companies. There's about 2.6 billion in companies that that have practices that are cruel to animals, primarily testing products on animals, for example. And there's about 1.9 billion in weapons production, and that's because these percentages are so high in issues that the public are concerned about, because typically these funds spread their investments over a whole lot of companies, as we talked about, that strategy of diversification. But in doing so, they ignore the impact of those investments on people, the environment, and the climate. So they don't screen out or exclude those companies that may be harmful. So that's kind of the area, the first of those areas we talked about on that chart, where we talked about avoiding harm. And what we find is that lots of people want to avoid harm, but actually it's surprising that a lot of funds don't do that, and or don't do it nearly to the extent that people are looking for. So the other question that we then get is, so if that's about avoiding, what's this area called engagement, or influencing companies, often called stewardship? So Moana, I'll pass it to you to talk about that whole area of stewardship and engagement.
Yeah, great. So maybe taking a few steps back, if you think about sort of stewardship, it's a term that maybe our audience might not be familiar with, and it's about shaping sort of positive outcomes for the broader economy, for the environment, and for our society and social systems, so that the kind of cumulative impact of these kind of externalities and costs aren't sort of taken on by other companies. So let's say a fossil fuel company, for example, a company that mines coal, they may be generating returns, they may be quite a good investment on one hand, but the carbon emissions that they're generating is going to have an impact on global warming in 10 years' time. And what's that system level impact that's going to have, both on the economy, but also sort of your portfolio level as well. And there are two primary sort of approaches within our stewardship approach, and that's proxy voting as well as company engagement. And proxy voting at a high level is basically every year a company puts forward a number of resolutions, and shareholders can vote on directors, they can vote on the remuneration report and other shareholder proposals as well. And it really signals to management what the priorities are for shareholders. and it can really signal quite strongly to a company whether a director is doing their job. So, for example, the director of that sits on the sustainability committee might get votes against, as we've seen in Woodside here in Australia recently, because of their lack of action on climate. And sort of a separate point is that engagement piece as well. So we'll engage with companies to try and promote a better environmental and social practices so that they manage that long-term risk and how they can sort of build shareholder value over time, because something that might not necessarily be seen as a risk today might actually influence the company as well as the customers and environment and social systems that they are connected to through time. So that's a high level sort of overview.
Thanks, Moana. And I guess one of the things that's important is the reporting that the fund managers do to people who invest in them, because I guess sometimes it's very easy for funds to say, "Oh, yes, we're engaging with these companies and voting our shares," but the question is, does it actually make any difference? Particularly seeing, New Zealand funds are typically a very small proportion of global shareholding. So I guess Moana, Alphinity is one of the funds that has reports on whether this makes a difference. Can you talk a little bit about how you do that and how difficult it is to be able to say, does all of this kind of voting and engagement actually make a difference to these companies?
Yeah, it's a really good question, and there's definitely more the scrutiny around fund managers making claims around positive impact and engagement outcomes. Maybe just two examples to set the context on the proxy voting side. So Exxon in the global space is a company where shareholder activism and shareholder voting really did result in a significant change to the board structure. There were 3 new directors being employed to explore sort of green energy options and prioritize their climate strategy. Maybe a softer example here in Australia, over the last 3 years, the 4 commercial retail banks, so you'll see ANZ, NAB, CommBank and Westpac, they've actually been receiving shareholder proposals on stronger disclosures about their financed emissions and lending. And although those proposals did not get many votes for, it's really changed the conversation that we're having with companies on the topic. So the banks are very transparent about their kind of lending practices. They're helping their customers reduce their emissions, especially for the high emitters. And they're holding climate briefs 2 or 3 times a year now with investors. And we're seeing that that's taken a fair bit of their ESG strategy as a focus. So those are kind of that's a softer example. Maybe one that we're quite proud of is our engagement with Woolworths on their stronger health strategy. So they're known as the fresh food people. They're a very, very large supermarket here, but we noticed that they've got a really strong health strategy around their own brand products, but sort of positioning healthy products in the supermarket, adding snacks and lollies to the checkout aisles where kids, it's at eye level. It's something we've been engaging with them on for a couple of years now, and actually last month they announced that they're removing confectionery from the checkout aisles, and it was a small win for us, and it's something that we'll continue engaging with Woolworths about. But it was really positive to see that they are hearing shareholders on these, and it hasn't been escalated to the point where you need to speak to sort of board or need to vote against directors on a strategy. So 2 examples there.
Yeah, great. Thank you. And for everyone, in 2 weeks' time, we're going to do a deep dive on on the issues around engagement and stewardship. So mark your calendars for Wednesday, 9th of August. And this is not only going to be an online seminar, but actually we're going to do it in person at a law firm called Minter Ellison Rudd Watts in the downtown Auckland. For those of you who are around Auckland, you're welcome to come in person. And otherwise, for those who aren't around, you can join online. So the details of that are on Mindful Money's website, and actually on the now we've set up a new crowdcast invitation for that. So
Maybe just another point
let's
to mention
carry on.
on
Yeah.
that, Barry. As a fund manager as well, we take a lot of pride in providing sort of transparency and case studies to the market. So every year we do publish an annual ESG and Sustainability Report. We're actually seeing other fund managers do the same, that really showcase some of the sort of escalation pathways when it comes to difficult sustainability issues, some of the engagement outcomes, some of the proxy voting examples as well. And I think that's something that individuals and advisors can really look for. And we're seeing that disclosures are becoming much more transparent from fund managers to try and connect the dots, really. A fund might have sustainable values, but are they acting in line with those, and also acting in line with the views of their clients?
Cool. Thank you, Moana. That's great. So we're going to move on, and we're going to move to the other area on that chart we showed. On the right-hand side, we showed the investing for positive impact. So this is important for New Zealand investors. We find in our annual surveys that actually people really want to invest with positive impact. And unfortunately, recently that's been quite hard to do because there haven't been any particular funds that focus on just impact investing. And the mainstream funds haven't really put much money into that as a part of their overall investment portfolio. What's changed recently is that some of these mainstream fund managers are now starting to ramp up the amount of money that they're putting into uh, issues. And a good example is a particular fund called Generate. KiwiSaver was the first to put money into a social housing project for the Salvation Army. So the Salvation Army was building 118 social houses in Auckland, and an intermediary called Community Finance put together a kind of financial package that they then said, well, this is kind of a loan that you can give from the KiwiSaver fund into this social housing project, and you're going to get pretty assured income because the social housing rents are paid for by the government. So actually, it's a pretty low risk investment. And then the KiwiSaver fund initially Generate, and then other funds like Simplicity and Pathfinder and others put money into that social housing project. And I think that's the kind of ways that we're now starting to see mainstream fund management supporting these issues. It's also been similar examples in investment in renewable energy companies, for example. So these are important, and we're seeing more and more of them amongst New Zealand mainstream companies, and Mindful Money's got a project to try and say, how can we accelerate this, not only for just one or two fund managers, but across all fund managers, because that could really start to mobilize funding for New Zealand's priorities, not only social housing, renewable energy, but some of our infrastructure challenges, some of our social challenges aside from housing, etc. I think this is a really important stage where this $90 billion now we have in KiwiSaver, and a whole lot more money in other investment funds can start to be put to use for positive purposes. Moana, did you want to add anything to the impact explanation?
Yeah, I think, like you say, the impact market is quite small. If you think of a piece of the pie, you got that sustainable and ethical fund space. It's actually growing significantly in Australia. There's a lot of demand for those types of projects. Well, what I would we talk to is in Europe at the moment, there's a really interesting sustainable finance sort of regulation that's coming into place, and it actually groups the funds in the market as having a sustainable objective, taking into account environmental and social characteristics, and then nothing at all. And the flows that are going to the Article 9 funds, which is that dark green area, are much higher than the Article 8 funds. So you're seeing, because of regulation, because of sort of fund labeling, there's a lot more money and a lot more emphasis on having positive impact through your investments. And that doesn't necessarily have to be through impact funds. It can be through sustainable funds that have kind of clear metrics and measures that they follow through time. Us as sort of large equity investors, it is sometimes difficult to determine that our engagement specifically has actually demonstrated an outcome. But things that we would like to measure, and we see that sustainable funds are doing more often, is in a company that you've invested in, how many healthcare patients have they reached every year? Is that growing year on year? Are they growing the population of underrepresented groups in that? So there are metrics, I think, that equity funds can follow, and they're looking to follow, and we can encourage companies to report that as well, because once those metrics are reported, then you can try to understand the positive impact that these companies are having in society and in the environment.
Yeah, and we're calling for that kind of regulation in New Zealand as well. You know, the EU has led the way in saying, you know, we need to define sort of what the regulations are around these measures for positive impact. And that's really important because it gives people the confidence to say, yes, we can actually be assured that our money is going into these good companies, and these good companies are delivering on their impacts. One of the things that people can do is we've got an impact directory on the Mindful Money website. If you go onto the website and you look under funds, there's a impact directory there, and it includes funds that basically are of two types. One is for retail investors, and that's either clean energy funds, for example, where the investments are in renewable energies, or it's mainstream funds that invest some of their money into impact companies. And there are some examples on our website there. The other part of the directory is the things that members of the public can't easily invest in themselves. They require you to be what's called a wholesale investor or a professional investor. And those companies are some really good funds that are investing often in early stage high-tech businesses on climate solutions, for example, or in community development projects that are having real benefits at the community level. So there are some good options for those people who've got a bit more money to invest or have experience of financial management. You can look up whether your can be defined as a wholesale investor, and then it opens up new kinds of investments that you can do that aren't available to most individuals. So all of that information's on our website. We're going to carry on and just relate some of that discussion to climate change. So the question we often get is, how does my KiwiSaver affect the climate? You know, what's the connection between climate change and my KiwiSaver investment? And, you know, at the most basic level, your money is invested in companies, and those companies emit greenhouse gases. So if you add up the total of all the company emissions from your KiwiSaver funds, actually we call that financed emissions. And it's your financing of the emissions by companies. And if you add those up and compare them to other parts of your climate footprint, it's actually generally as big or bigger than all your emissions from your transport, from flights or from driving a car, etc. It's generally bigger than your electricity use, or bigger than the emissions from the food you eat. So it's important, it's large, and the good news is that you can manage it. You can either choose a lower emissions fund to invest in, or you can choose a fund that's actively reducing their emissions. So, Moana, do you want to just explain to the audience how fund managers reduce the impact of their investments on the climate?
Yeah, well, there's a few different ways to do that. The first I would call out is divestment. So a fund might not invest in fossil fuels. All of our funds at Alphinity don't invest in thermal coal production. But that doesn't necessarily relate or lead to an absolute emissions reduction in the real world. Our fund might have a lower carbon intensity compared to a peer, but that doesn't mean that it's just really driving investment away from certain companies. So the second sort of approach is really important in our climate management strategy is sort of engagement, active monitoring. So what we do is we review company disclosures and their climate strategies. A vast majority of Australian listed companies now have net zero commitments by 2050 or earlier, but they're not necessarily supported by sort of short-term targets. And that's what we're really trying to hone in on now is, yes, you have this broader aspiration for 2050 net zero, but how are you going to reduce emissions along the way? How are you going to switch your business model for it to make sense? So are you electrifying your fleet? Are you piloting projects in sort of electric haulage in mining, for example? Are you looking into new energy like renewables? Are you looking into hydrogen? How are you going to be reducing the emissions impact of your products and services? And I think here in Australia, it's an interesting market because we don't really have any renewable energy pure plays, but we do have a lot of high emitters. So we have industrials, steel, cement, the mining companies, as well as energy. And it's really interesting sort of engaging on what these companies are doing from an operational perspective in terms of piloting. IGO is a good copper and nickel small miner that's operating in Western Australia, and they're planning to basically have a fully electric mine when that Nova mine is released completed in 2025, and Fortescue Metals Group as well as piloting sort of hydrogen projects, and a fascinating kind of digital technology angle where they're trying to have sort of digital twins and trying to have an end-to-end map of where their emissions are from mine to customer and going forward. So you can try and sort of look at how a company is reducing its emissions, how it plans to, and if we have confidence in that as well, because that's important. If they've set out a target, and we've got the Australian sort of carbon regulation now coming in as well, they're going to be pressured and they're going to have increased costs over time if they're not thinking about what that decarbonisation pathway looks like.
Yeah. So, on the first point of divestment, there is an active debate over whether divestment works, and certainly from the evidence that Mindful Money has seen that actually large scale, if you're an individual investor and you don't invest in a company, it doesn't make a difference. But if a lot of people don't together, it actually makes a huge difference to those companies and means that their cost of their money, their cost of their capital is much higher and they're disadvantaged. So it's one of the ways that we can get this transition from the traditional fossil fuels through to the clean energy companies. And we've got a categorization now on the Mindful Money website. Just done a report that says what are the companies that are in transition to a 1.5 degrees, so it's a relatively safe climate trajectory, and which of those companies are more part of the problem. And the companies that are part of the problem are primarily those that are still expanding their production and their field development. So they are just kind of heading for the edge of the cliff, and they're about to kind of have a big disruption in the industry, and potentially it's financially very risky to invest in those companies because already there's enough fossil fuels that are in production to satisfy consumer demand. We don't need to be exploring and developing any new oil and gas fields. So that's kind of our advice on Mindful Money. Go and have a look at the types of companies in your portfolio. It's easy to go and see your portfolio on the Mindful Money website, and you can check your fund, and you can look for companies that funds that are free from fossil fuels. So that's a good way that you can start to manage your emissions. And as Moana said, you can also start to look for the companies that also engage to try and drive emissions down and help companies along 1.5 degree pathway. Hey,
I
we're
would
coming
love
to the
to.
end of sorry,
I would just
we're
love
coming to
to.
the end of, yeah, carry on. Yeah,
No, no, just wanted to quickly add that sort of emissions itself is not just related to sort of energy or fossil fuels. I mean, we
yeah,
recently did a research project on fashion, and fashion itself contributes to 10% of the global emissions footprint. So, sort of thinking about circular systems, waste management, sort of more sustainable consumption practices all feed into that climate sort of management strategy. And it's something that investors can think about as well. Through a wide range of sectors. It just doesn't have to be the high emitting sectors themselves.
yeah, yeah. Good point. Good point. Hey, just before we finish, we've got about 5 minutes to go. Monica, people often say, if I invest ethically, am I going to get lower returns? Do you want to give a snapshot from the evidence that Alphinity has around that?
Mm-hmm. I have really strong views on this, that there's no evidence to suggest that returns are compromised for sustainable decisions. If you have a really skilled manager that applies a strong investment process to a selected universe of sustainable companies, for our sustainable funds, we've actually outperformed the benchmark in our core funds over sort of 10-year, 3-year, and 5-year time horizons. But just to caveat that, over the last couple of years, with the inflation in fossil fuel prices because of the gas shortage in Europe, we are seeing oil and gas companies and thermal coal companies outperform. And through those periods, you can expect that these funds will be under benchmark because you're excluding a whole sector. But over the longer term, it's definitely not a sacrifice, and you just need to pick the right manager and make sure that they're doing exactly what they're saying they're doing. And over time, I suspect that sort of funds that don't take into account proper environmental and social considerations, they're going to have a social license risk. They're going to have regulatory risk. And we're seeing that here in Australia. There was not really any climate action here from the government for 8 years. And suddenly, 12 months ago, it wasn't a conversation, but now we have a full sort of legislated carbon emissions reduction strategy in place. And it's going to cost companies that didn't think about it or were stalling for the next 8 years. So to me, it's quite an easy answer.
Yeah, I agree with that entirely, and Mindful Money's got some evidence posted on our website from huge studies of thousands of funds, and the conclusion is, as you said, Moana, there's nothing to suggest that ethical funds have any lower returns. In fact, it skews on the other side over the long term, that in fact ethical funds uh, often perform better than the traditional funds. And one of the reasons you gave the example of fossil fuels, if you look over a couple of years, fossil fuel companies have done okay. You know, the big oil and gas companies have done quite well after the Russian invasion of Ukraine. But if you look back over 10 years, then those fossil fuel companies have done terribly. Actually, they have lost money if you have invested in those fossil fuel companies compared to average returns that have gone up by over 10%. So while it appears sometimes that there's a reason to kind of jump on a bandwagon to invest in unethical companies over the long term, I think the strong evidence from New Zealand and Australia and elsewhere in the world is that investing ethically is generally good for managing the risks of your investments. So you don't have risks of environmental liabilities or risks of a damage to your reputation, etc. Um, but also a good way of also having a good level of returns. Moana, just final question. Final question we get is people say, how can I avoid a fund that is just greenwashing? It's talking about ethical investing, but it's not walking the talk. Do you have some tips for people on how to do that?
Yeah, I mean, there's two things I would really look for if I was sort of an individual investor. I think firstly, having a really clear sustainability assessment process and having those safeguards in place and the governance structures in place to make sure that a company that doesn't fit in the fund doesn't get into the fund. So that's the first side, and then the second part would be you want a fund manager to have good case studies on what is in the fund and why it's in the fund, as well as companies that are not in the fund and the reason why. So a company like Worley in the Australian market is an engineering company, and primarily they've serviced the oil and gas sector and the energy sector for many years. And although they don't directly contribute to fossil fuel production, which is our exclusion in the sustainable fund, logically it didn't make sense, I don't think, at the moment, unfortunately. They are trying to drive kind of sustainable revenues, but it sits in that grey area. So just having good examples of where a company has crossed the line or not, I think is really positive, and supporting that with fact sheets, an annual ESG report. And for us, I think it was really important that we got a third-party auditor to provide assurance over our SDG sort of sustainability analysis, because again, sustainability is nuanced and there's always going to be grey areas. So just having kind of that third-party view is really important, I think. And greenwashing there's a huge crackdown from the regulator here. I think last year there were kind of 11 infringement notices that were provided to both companies and funds, and that resulted in a range of different sort of changes in disclosure. So it's on the radar.
The regulator in New Zealand, the Financial Markets Authority, is also looking pretty closely at potentially misleading claims that could be called greenwashing. If you're in New Zealand, then an obvious thing you can do is hop onto Mindful Money and go and find out what companies are actually in your fund, because the ultimate objective truth is often, so what do you invest in? And so we provide not only a kind of a list of the companies, but we talk about whether or not they fit into different categories, whether or not they are fossil fuel companies or weapons companies, or whether they have a record of violating human rights, etc. So people can see all that information for free. It's nice and easy to use, and seeing we're a charity, we do that kind of thing. And then we can provide also ways for people to find a more ethical fund, using a kind of a minimum standard for what are good standards for ethical funds, and very much it's around the issues that we've been talking about. It's avoiding harm, it's engaging to improve the performance of companies, and it's about investing in positive impact companies. So that's all from the seminar today. Thank you so much, Moana, for joining us. It's been lovely being in conversation with you. So really appreciate it. Thanks for joining us.
Thanks, Barry.
Just to conclude, this series of our seminars would not be possible without our generous donors, of which the Moana's company Alphinity is one of our generous donors. So thank you very much to Alphinity for sponsoring us. Also, Medical Assurance Society, known as MAS, Mercer, and the New Zealand Green Investment Finance. It's the government fund for climate finance. We also have support from Chapman Tripp, from Booster, from Harbour Asset Management, and from trustees, executors, and for sponsorship, we also have Pathfinder and Pi Funds. So thanks to all of our sponsors. They make this series possible, and really help Mindful Money to bring this message out to members of the public. So see you in 2 weeks' time, Wednesday, 9th of August. Going to do a deep dive into the stewardship and engagement issues. We've got a great panel, and we're also going to talk about the New Zealand Stewardship Code, a new code on the principles for sustainability and stewardship. So that's at Minter Ellison Rudd Watts in the PwC Tower downtown in Auckland, or you can watch it on Crowdcast online. So again, thanks very much for joining us. I hope you invest mindfully, stay active. Ngā mihi nui kia koutou. Mā te wā.